Hi, I'm Lachlan Campbell, the founder of Mad Success, and welcome to my bond mini course. What are bonds? Basically, what I'm going to do in this course is I'm going to walk you through what they are, how they operate. I'm going to teach you some languages of bonds, the language of bonds, some of the basic terminology. I'm going to show you the inverse relationship between price and yield and how that works. We'll talk about interest rates. We'll talk a little bit about the current market, teach about what's happening in late 2022, and we're heading into recession, rising interest rates. How is that impacting the bond market? And we'll talk about where you can invest in the bond market, individual bonds, or to have capital gain, or to gain yield, or getting into bond funds. And we'll talk about that towards the end. But this is going to be presented like a mini course. I'm using charts. I'm going to be using a mouse to kind of highlight things. And so you can come to this and come back to it and use it as a resource. Look, I spent decades in asset management. I was a bond credit analyst for many years, and then I became a bond investment manager. So I used to manage hundreds of millions of US dollars in bonds, in bond portfolios. So I've been there, done that, and I know this market inside and out. But I'm going to talk at a level where entry-level investors can start to understand bonds and take away some of the fear and take away some of the uncertainty and lack of familiarity to terms and terminology and how they work. But my eyes are going to drop down to my screen from time to time as I look at my charts and I walk you through what the learning points are. So don't mind me as I head down there. But I hope you enjoy this, and I hope it's useful for you, because with rising interest rates, we're now, and we'll get into the details of this, but now with the 10-year bond at 4%, we're starting to get into a very interesting area of yield, where historically, over the last 50 years, bond yields have been above 5% or higher for many of those years. And I'm going to show you that on some graphs. So we're getting back to a place where yields on bonds, the total return of bonds, are getting competitive with where dividends are in stocks and with the returns in real estate rental market, the return on investment from your rental properties, if you have any. So bonds are now becoming competitive again because inflation has been so aggressive, interest rates have had to rise aggressively and are expected to continue to do so. So bonds are now becoming a real opportunity to invest in. So bear with me, and here we go. What are bonds? Slide 2. So bonds are an IOU. An IOU, you borrow money from me, you owe me. I borrow money from you, I owe you. That's all that means. It's a loan, okay? So bonds are an IOU. Bonds are loans issued by governments and corporates, okay? We, as investors in bonds, actually are lenders. If we put money into a bond, we're actually lending that government or lending that corporation our money. A bond is a loan. It's an IOU. So you're lending as an investor. So we call it investing because we're getting a certain amount of return, like we would in the stock market or with real estate. We're looking for those capital gains and that passive income. But bonds are debt by the borrower. And so we're funding that debt by investing into bonds. So remember, you're not an owner of the company like you are in shares. You're a lender, like a bank. Banks lend us money to buy our homes or to buy cars or other things, right? And so that's what a bond is. A bond is a loan. It's a debt. So some basic bond language. You hear me in my other videos. I talk a lot about the languages of money, right? So we have languages of economics, languages of accounting, languages of investing, and this is investing language. This is the language of bonds. So we've got 6 main points: the borrower, the lender, maturity, what is par, face value, the coupon, and the coupon frequency. So these are basic terms that you will want to learn and know. So the borrower is the person that needs the money, or the company or the government that needs money. They have a purpose for that money or a use, and they're going to put it to work, and they're going to borrow money from you. So you're the lender. The investor is the lender. You're lending money to the borrower. The maturity is the end date of the bond when the borrower has to pay the full amount of money back to you. So if you lend $1,000 to the borrower, then at the end for 5 years, then at the end of 5 years, that's the maturity date. That's when they have to pay you the $1,000 back, okay? The face value or par value is the amount that needs to be repaid at maturity. So again, if you've lent $1,000, you expect to get $1,000 back at maturity. That's the par value or the maturity value. Coupon is the amount of interest on the loan, interest on the bond, on the debt. So if the bond was paying an interest rate, a coupon rate of 3%, then that's your coupon. That's the interest. That's their cost of borrowing. So whenever that bond was launched, it cost that government or cost that company 3% to borrow money from you, the lender, okay? Interest rates right now, the 10-year government bond is at 4%. So if the US Treasury this week was issuing a bond, they would be paying somewhere around 4% for 10-year debt, okay? And that would become the coupon. 4% would become the coupon that they would have to pay every year, paying 4% for 10 years. And then at the end of 10 years, the maturity date, they have to pay the money back to the investors, okay? The coupon frequency means how often during the year is the annual interest paid. So if the coupon is 4% for the duration of the loan to maturity, the debt to maturity, every year they have to pay 4%. And so maybe it's divided into semi-annual, so they pay half of it every 6 months. Maybe it's divided into quarterly, so they pay 1% basically every quarter. Every 3 months they're paying 1%. So if it's a 4% coupon and it's paid quarterly, basically you're getting 1% every quarter, and you'll get 4% for the year. So that's how that works. So sometimes coupons are monthly, sometimes they're quarterly, sometimes semi-annually, sometimes annually. So sometimes they're only paid once a year, okay? So that's what frequency means. So let's go into some examples. So a bond is a loan. A loan example, number one, Matt borrows $15 from me and has to pay me back by Saturday, but I don't charge him any interest. There's no interest cost, so there's no coupon. I'm not formally issuing a bond. Of course, it's only a few days, but it's a loan. And so the same for a bond example, the company's borrowing money. So just like Matt borrowed $15, the company's now borrowing $100 million, which is quite common in the bond market. Often they're borrowing 500 million or $1 billion, big numbers. And so they're borrowing 100 million. This is a 10-year bond. They're borrowing the money for 10 years and they're going to pay 4% interest. So that's what the current rate is in the market for US government bonds. This is a company, and we don't show the rating here, how risky they are, but we'll assume, that let's say they're on par, or say they're AAA company, same as US government. And they're borrowing the money for 10 years at 4%, okay? So let's depict that. So here we have it. I've got a little handy pen here. It's in US dollars, this borrowing. Matt and the company are the borrowers, okay? The amounts are $15 for Matt and 100 million for the company. The maturity for Matt is Saturday, and the maturity for the company is in 10 years. Matt has 0% interest, zero coupon, and the company has 4%. There's no frequency. Matt just has to pay me back the full amount, no interest on Saturday. And the company pays interest on a quarterly basis. So remember I said if you had a 4% annual coupon, if they're paying quarterly, it's effectively 1%, because a quarter of 4 is 1. So 1% every quarter they're paying for 10 years, okay? So they're paying 1% every quarter for over 10 years. So that's what these main terms are. I spoke about the main terms here, right? Borrower, lender, maturity, face value, coupon, and frequency. And that's the same thing here. Borrower, the amount, the lender I didn't put in here, but I've said the amount of money from the lender, the maturity date, the coupon, and the frequency of the coupon. In this case, it's quarterly. Okay, let's keep going. So some more bond language. Credit rating, that's the assessment of a borrower's default risk. Well, what is default risk? That's the risk that the bond will not be paid back in full, okay? That they're not going to pay it back. But default risk also applies to the coupon, to the interest on the loan, okay, on the bond. If the borrower defaults on the interest, it is also a default. It's a bond default, and that leads to all sorts of other complications. But your risk is, as the lender, is that they don't pay you back. You don't get the interest and they don't pay you back the bond. That's the risk. So what is the yield? The yield is the total expected return on the bond if the bond is held to maturity. So if the yield is 5%, but the coupon's 4%, it means that interest rates have risen and you've got a 4% coupon, but now you're earning a bit more money, so the price will have fallen. We'll talk about that relationship. Price will be down, you bought in at a lower price, and you're getting the 4% coupon, and your yield is 5%, and that's your total return. So you're getting some gains from the price decline. You bought in at a lower rate, and you're getting some coupon. But we'll go into much more depth on that, so you're not confused, okay? Duration is the amount by which a bond price moves based on movements in interest rate. So shorter dated bonds don't move, the price doesn't move very much as aggressively with movements in interest rates, but long dated bonds, long maturity bonds that have much longer duration, the price moves much more aggressively for small movements in interest rates. Okay, so that's the thing you need to remember. Long maturity means that the price moves more aggressively for that incremental movement in interest rates compared to short dated bonds, okay? Collateral is the underlying asset, so it's the security tied to the bond. Now, not all bonds are secured, and if they're not, they're called unsecured debt or unsecured bonds. So, what is security or collateral? It's the same thing as your home on a bank loan, a bank mortgage. So when the bank lends you money to buy a house, they take the house as security. So if you default, if you stop paying your mortgage, the bank can take away your home. Well, the same thing with a secured bond. If the company stops paying the bond and they go into default, you as investors can take their assets. And it's done in a formal way, and the assets get sold, and whatever money's left over, whatever value's left in the business goes to the varying creditors. So it's not always guaranteed, even if you have a secured bond, it's not always guaranteed there'll be money left to pay you. The government gets paid first, so if there's any taxes owing, so if assets are sold, the government gets paid. Certain banks, if they had lending to the company, they may have seniority above your bond. They get paid next, and then if your bond is senior enough, your bond, whatever's left over, may get paid back, but it's likely pennies on the dollar. You're probably not getting back at par at face value. You might get 80 cents or 60 cents or 50 cents on the dollar or less, depending on how, what kind of shape the company was in when it went into liquidation. So collateral is there to protect you, but it doesn't always give you full protection. So bond risk, let's talk about credit ratings. So this table looks a little bit tricky. Let me explain it to you. There are 3 columns, and that's because there's 3 primary credit rating agencies, global agencies: Moody's, S&P, which is Standard and Poor's, and Fitch. Now, if you know the equity world, the S&P Standard and Poor's 500 index is the top 500 stocks, top 500 companies in the US market. So often we'll recommend to new investors to look at buying the S&P 500 stock index. Well, S&P does indices, prepares indices for markets. They do credit ratings. They're a big company. They do lots of things in different markets and for different uses and programs that companies need. So in fact, they provide also credit ratings. Moody's and Fitch also provide credit ratings. So let's talk about this. The credit rating, again, is the assessment of the borrower's default risk. So as we go down, we become riskier. So AAA are the top rated companies and governments in the world. okay? AAA is as high as it goes. So if you're rated AAA, like Canada or Finland or Germany, the US has a split rating. They have AAA with Moody's, and I think it's S&P where it's AA1 or a AA plus. And but there are top countries that are AAA, there are some that are AA, there's single A, triple B, and then there's this black line here. This goes into what's called non-investment grade or speculative grade or junk. It's all the same thing. High yield, non-investment grade, speculative grade, junk bonds, they're all the same thing. It means they're below this line. So they're below triple B, they're in the double B, single B, or C category. Below C is D for default. D for default. If a company's in default, they're rated D, standard, okay? So the lower the credit rating, the higher the risk that that company or government will default. So they need to pay a lot more interest, a lot more coupon on their borrowing for you as an investor to be willing to lend them money. Okay, so let's go look at some governments right now. So here's an example. We've got non-investment grade shown in these red boxes, and there's some further ones down here in red, and we've got investment grade. AAA is called the risk-free rate. If something's rated AAA, it's pretty much guaranteed it's not going to go bust. Okay, so we call that risk-free. And Finland here is AAA. Up here, Denmark is AAA. And we have Germany is also AAA. So these are they're the top rated countries on this little section of the country report. This comes from The Guardian. They have a great annual update on ratings. And it's very clear, this first column is S&P. Oops, I'm moving my slide. This first column is S&P. This next column is Moody's. You can tell Moody's has the new numbering system. If I just take you back a chart, Moody's does numbers, so triple for their double A, it's either 1, 2, or 3. So double A1 is higher than double A2, which is higher than double A3. But S&P and Fitch use a plus-minus system. So A1 is the same as the plus, or they have A2, which is AA, or A3, which is A minus equivalent, or double A minus equivalent. So the same thing here. Here's single A, it's 1, 2, 3, or plus, neutral, minus, and so on down the road. So just so you know that. So over here, what we see is the credit rating highlights the risk associated with an investment in the country's bonds. So we talked about that. The lower the rating, the lower the quality, and then the higher the risk and the higher the yield, the higher the cost that they need to pay you as an investor. Okay, so I think that should be clear by now. So how are bonds priced? How are bonds priced? Well, they're priced against the interest rate. So the interest rate comes first. It's not chicken and egg, and I'm not confused. It's all about the interest rates, okay? So that's why the title here is Interest Rates, How Are Bonds Priced? Central banks, so these abbreviations here, this is the Fed, Federal Reserve Bank in the US, BOE is Bank of England, BOC is Bank of China, etc. They set their own base rate. Okay, so the base rate is what is called in the US, the Fed funds rate is the base rate. And what is the base rate? Well, it is the rate by which banks borrow money from the central bank. So it's the rate by which domestic banks borrow from their central bank. So in the US, it might be Bank of America or Citibank. And they go to the central bank and they need to borrow money to prop up their reserves, their risk reserves, or they need to borrow money for lending, but they'll pay the central bank the base rate, the Fed funds rate. And so as the base rate rises, that is what starts to impact our borrowing as customers from banks. So the banks set their lending rates to customers as a percentage above the base rate. So right now, the base rate, the Fed funds rate, is 3.25% as of a couple days ago. Okay, in mid-October 2022, the base rate's 3.25%. So banks make their money, their revenue, their income comes from setting their lending rates above what they borrow from the central bank. So that's their cost. They borrow at a cost and they lend their money out, banks lend out to you and me and to companies, okay? And if you are considered to be a risky borrower, well, what did we just talk about? Risky borrowers pay more interest. And it's the same thing what the banks do as what happens in the bond market. If you're a risky borrower and you're a subprime mortgage borrower, you're going to pay a lot higher interest than if you're a prime account for the bank, okay? And if you're a corporate, you might pay even less than what individuals pay, depending on your own risk, all right, as a company. So banks make their money by setting the lending rate above the base rate. Then we have short-term government bonds, and they tend to move with the base rate, right? So if something's 1 month or 3 months or 1 year short-term in the US, it's called a bill, T-bill, Treasury bill. So the government bonds in the US will trade slight premium to what the base rate is, because the longer the maturity, the more risk is perceived, and we'll talk about that. So then the higher the interest rate has to be. Longer dated bonds, so 10-year, 30-year, 100-century bonds, move based on interest rates in the short term, but they also move on long-term expectations of what's happening with economics, both within the country and in the world, okay? So long-dated bonds are typically more impacted by sort of bigger picture, longer-dated expectations of economic recovery or recession or what have you, but we'll get into that because right now we have what's called an inverted yield curve in the US, and I'll talk about that in a minute. Corporate bonds price against government bonds. So just like how the bank prices its lending, well, corporate bonds have to price against the equivalent maturity government bond. So government bonds price against the base rate's here, government bonds price against the base rate, and then corporate bonds price against the equivalent maturity government bond. So if it's a 10-year a corporate wants to issue a 10-year bond, it prices against the underlying government in the same currency, okay? So if it's a US dollar bond that's being issued, it prices against the US Treasury because that's in US dollars. If a company in England wants to issue a pounds, Great British pounds bond, they're going to price against sterling bonds. They're going to price against gilts, whether the British government bonds. Okay, if it's a euro-denominated corporate bond, it'll price against euro region bonds. Same with yen. Japanese yen-denominated bond will price against the JGBs, the Japanese government bonds, okay? And so in all my examples in this mini course are in US dollars. So we're gonna price everything against US treasuries, okay? But that dollar, pounds, euro, yen comparison is really important. Canadian bonds price against Canadian government bonds. Aussie corporate bonds price against the Aussie dollar government bonds, and so on, okay? But the premium that a corporate pays above the government bond is called a credit spread. So let's talk about that. So credit spreads are the risk premium that the corporate has to pay above the government bond. So let's talk about that. So here we have 10-year corporate bonds, and we're talking about yields. Now these are not current. This is just for example purposes, okay? The 10-year US Treasury is now already at 4%. I could have put that in there, but I built this before it got to that point. So the 10-year Treasury is at 4%, and we're going to call it AAA rated, even though it's a split rating. A 10-year corporate bond issued by a AA might have to pay a premium of, let's say, 50 basis points, or half of 1%. So a basis point is a terminology used in bonds and in loans and in debt. It's 1/100th of 1%. So 100 basis points equals 1%, okay? So In this case, the AA bond is paying 50 basis points or 0.5% more than the government bond. A BBB, which is a lower rated bond but still investment grade, might be paying 1% more, 100 basis points more than the government bond. So it's at 4%. Now we get into non-investment grade junk bonds. This guy's a single B only. Well, he's paying 2.5% more than the government bond. And that's what's called a credit spread. So let's walk through this. The 10-year treasury, all US dollar bonds on the 10-year maturity price against the 10-year government bond, the 10-year treasury. Credit spreads, the additional cost of borrowing for increased default risk. So as the rating drops, the default risk increases. So the lower the credit rating, the greater the company risk. The greater the company risk, the more interest the company needs to pay. The more interest they need to pay, the more you as an investor can get as a return on your investment, but you're going into much greater risk as the yield, as the payment increases, right? So as you get down into, deep non-investment grade junk bond territory, yeah, you're getting higher yield, but you're also getting a lot more risk of potential default. And I'm going to go into some charts on that, not just this second. So interest rates. Here's what's happened with the Fed funds rate over the last 60, 70 years. Back in the 1980s, the Fed funds rate, the bank lending rate, was 20%. 20%. We just came off of 0.25% for the prior decade after the global financial crisis, and we're now at 3.25% in the Fed funds rate, right? The base rate for the US. But it peaked during the OPEC oil crisis. There was massive inflation, and you paid, the government was paying 20% to banks. So pretty remarkable where we've come from. This, when interest rates fall, which is what happened here, from 20% down to nearly zero, that meant bond prices rose. So this was a 40-year bull market in bonds. 40-year bull market, and now that's reversing as interest rates rise and we head into recession. 40-year bull market. So a normal shaped yield curve starts down at the short maturity bonds and bills. A bill is a US government bond that is less than 1 year maturity. So anything below 1 year is called a bill. Anything above 1 year, 1 year and above, is called a bond. So these are treasury bonds, and below 1 year are treasury bills, okay? So the shorter dated the maturity, the less the risk of default, right? So you would expect in 1 month, the US government will be able to pay all of its bills, 1 month bills, but what about over 30 years? Well, we don't know. If we're heading into a recession, what if the US implodes somehow? What if there's, social unrest and we have a major crisis of confidence in the US, and the US is downgraded by the rating agencies, from AAA, AA down to single A or triple B. Let's say it was just a disaster and things collapsed over 30 years. Well, yeah, you would expect the interest rate to be a lot higher on the long end. And that's why we have an upward shaped yield curve is the normal yield curve, okay? But right today, we have what's called an inverted yield curve. And what's really important about the inverted yield curve means that the market sees much higher risk on the short end over the near term, and within the next 1 to 2 years, they see higher risk than over a 20, 30-year period. 10-year bonds are a lot lower than 3-year bonds. A lot lower. And that's what's called an inverted yield curve. And if you look over here at these words, over the past 50 years, an inverted yield curve every single time has predicted a recession within 12 months. And we've had an inverted yield curve in the US for about 6 months. So that means the likelihood of recession is coming in the first quarter or second quarter of 2023. And more talking heads on CNBC and CNN and so on are now, hearing this from major investors, major hedge fund managers, from folks in corporates that are looking at the economy and so on, that are analyzing what's happening in the economy, both in the US and globally. And it looks like we're heading into a doozy of a recession in 2023. Okay, so inverted yield curve predicts, in most cases, and certainly in the last 50 years, predicted every recession. And so it's not a normal way a yield curve is supposed to look. So the bond price yield relationship is inversed. When interest rates go up, bond prices go down. When interest rates come down, bond prices go up. What's happening in the market right now? Interest rates are going up, right? Inflation's super high, so the central banks are raising interest rates, and that means bond prices right now are going down. Well, stocks have also gone down because of expectations of recession. Corporate earnings are falling, so stock prices are falling because the expectations of future growth is falling. Well, interest rates are rising because inflation is so high, and bond prices are also falling at the same time that stocks are falling. So we now know that stocks are down, nearly 30%, S&P, NASDAQ, Dow Jones, and in places like Europe and UK and so on, stocks are down 20, 30% or more. It's a great opportunity to start buying into the market. Same with the bond market, and that's why I'm doing today's presentation. It's time to start taking bonds seriously for your portfolio, even if you're young, even if you're in your 20s. Now, in your 20s, you can take a lot more risk. You can pile into the equity market, pile into real estate, and bonds are kind of always seen as more of the safety bucket, especially the investment grade bonds, right? But with yields now back approaching historic sort of minimums, and I'll show you in a few charts, we're getting back into attractive levels where interest on bonds, the yield on bonds, is becoming comparable to dividends on stocks and to the rental returns on real estate. Those are the big three. Bonds, equities, and real estate are where we get our passive income from as investors, and bonds are now becoming attractive again. Look, we went from a decade of near 0% interest, and bonds were yielding 1-2%. Not sexy, not interesting, didn't need to know about them. You now need to know about bonds. You do, because we're getting back up at the 5%, 6%, 7% handle as we get back towards non-investment grade, starting to become a lot more attractive. So you want to know about bonds. So the price yield relationship, when interest rates decrease, bond prices go up. That's the first thing you need to know. Well, why does that happen? Let's go through an example. On October 1st of this year, you bought a $1,000 new issue bond with a 3% coupon with a 5-year maturity, okay? So the yield was at 3%, the coupon at launch, at par, at face value, was 3% for 5 years, okay? But this bond will pay $30 interest per year on $1,000, so it's 3% times 1,000, and I'll graphically present this in a sec. 3% times 1,000 is $30. It'll pay you $30 a year for each of the next 5 years. So you'll earn $30 times 5, $150 in interest over that 5-year period. And at the end of 5 years, at the maturity date, the $1,000 gets returned to you, so long as the company that issued the bond doesn't default, right? So if this is a AAA, and in our example here, we're going to assume it's AAA, the same as the US government, because this is in US dollars. We'll just say it's AAA, and the likelihood of getting paid back is very, very high, okay? So going into the example and depicting what I just said, it was a new issue on October 1st, right? It's a 5-year maturity, paying a 3% coupon, and we paid $1,000 of principal. We put $1,000 in, and that's the face value, the par value. The interest, as I said, was 3% times 1,000, $30 a year, every year for 5 years. And so the yield on the bond at issuance is 3%. The market price is 1,000. It hasn't gone up or down yet because it was just issued on October 1st. And the government 5-year interest rate was also at 3%. And this was AAA. The government is AAA. no issue about credit rating. We won't go into that in this example. So just know that they start at the same yield, okay? So the big question is, what happens if interest rates go up before your bond matures? Well, if you hold the bond to maturity, there's no impact. You're getting your 3%. But if interest rates rise to 5% and you hold your bond to maturity, you're only getting 3%. You're losing out. And because interest rates have risen, your bond has fallen in value. The actual price has declined. And we'll go into why that happens. But if you want to sell the bond before maturity, you will have to sell at a discount, at a loss, because as interest rates went up, your bond price went down. Now, if you don't sell, you've locked in a 3% yield all the way to maturity. No problem. You'll get your $30 a year for 5 years, and you'll get your $1,000 back at the end of 5 years. But interest rates have gone up 200 basis points, up 2%. So let's talk about that. Click on the next slide. So the top box here is the original data, okay? 5-year bond, 3% coupon, $1,000 face value, the yield was 3%. But what if interest rates rose from 3% to 5%, okay? Interest rates have gone to 5%. And what happens then to the bond? Well, similar bonds are now paying 5%. But our bond, this first bond, is only paying 3%. It's not very attractive. Bonds, the yields have gone up to 5%. So if I'm a new investor and I'm looking at the original bond with a 3% coupon, and I'm looking at a new bond with a 5% coupon, well, this one's more attractive. So how do I make this one more attractive to a new investor? The price goes down. Now, this investor, if he has to decide, or she has to decide, do I buy the bond at $960 instead of $1,000? So he got a discount, a lower price, and he's going to earn $40 over the rest of the life of the bond. Well, this is year 2. A year later, the bond price, interest rates have gone up, the bond price has gone down. So there's 4 years remaining on our 5-year bond, right? We're 1 year into it. And now a new investor can buy that bond at $960, but they're going to get paid $1,000 in 4 years. So they're going to earn $40 of capital gains, but they've still got 4 years left on the bond. So they're still going to get $30 of coupon. The coupon doesn't change just because the price went up and down. The coupon remains the same. That's important to remember. The coupon is the coupon, it's fixed. In this case, it's a fixed coupon, it's not a floating rate coupon. It's a fixed coupon, it doesn't change. $30, $30, $30 per year, no matter where the price is. Where we get the yield to be 5%, where the current market is, and we only have a 3% paying bond, we have to entice investors, the price has to come down. So they have to be able to get some capital gains plus the coupon, so their total return, which is the yield, will be about 5%. So then they decide if a new bond is coming out from the same company at 5% and it's a 4-year bond for 5%, or the old coupon at 3% for 4 years remaining at $960, basically they would be indifferent because both would be yielding about 5%. So they just have to decide, which one do I want to be in, right? But if the new issuance for 4 years at 5% was a different company, then you have to make a decision. Do I like that company better or this company better? They're both paying 5% effectively for the bond that I want to buy, 4-year bond. Which company do I choose? Well, I think this one is actually potentially going to get worse, and this one's actually going to do better. Maybe that 960 goes back faster. Maybe I can get some capital gains, and we'll talk about that a little bit later. So I hope that's clear. I'm trying to explain things, and I hope you're understanding. There's a lot to bonds. So let's talk about risk. Time and duration. The longer to maturity, the more risk there is because of uncertainty. I mentioned that earlier. Credit risk. The lower the credit rating, the more the risk. That's a quality issue. The lower the rating means the quality of the company or the government is not as high as one that's AAA. Okay? So that means an increased default risk. So default risk, your biggest risk when buying bonds is not getting paid back, not getting paid the interest and not getting your money back, the principal that you lent to the company or to the government, okay? Both the interest payments and the invested capital, the money you lent, are at risk when you go into bonds. You're lending the money. So maybe you don't get the interest payment and it goes into default, or at the very end, they start negotiating and say, look, we can't pay you in full. Can we extend the maturity? All these negotiations that happen when a company gets distressed, when they get into a point where they can't pay back the debt. That's called a distressed borrower. Okay, and distressed debt is a very interesting part of the market that I spent quite a few years in as an investment manager. After the Asian financial crisis, I was a distressed debt manager, investing hundreds of millions of US dollars into companies that were at 20 cents on the dollar. They're bond at par, 100, and I was buying them at 20 cents on the dollar, 30 cents on the dollar. But I did my research on these companies, went to Indonesia, went to Thailand, went to the Philippines, went to Taiwan, and looked at companies that were had a distressed debt outstanding, that had these bonds outstanding, and I assessed that some of these were excellent companies, but because of the Asian financial crisis, their debt was just killed, like the baby thrown out with the bathwater, the good thrown out with the bad. And I assessed some, and we made a killing in our bond funds. I was working for Schroders, one of the big international investment managers, and I was a Schroders bond fund manager for their Asian bond fund. And I looked after all the credit investing. So I analyzed governments and I analyzed corporates on their risk. And so we were buying paper at 20, 30, 40 cents on the dollar. And then when the economy started to turn, that paper went up often 2, 3, 4 multiples of what we bought. If we bought at 20 cents, sometimes we were selling at 80, earning a 4 times multiple on our money. It was really fun. But that's what default risk is. You're at risk of not getting paid back. Some other risks are currency risk. So if you operate in one currency and you invest in another, so the currency risk is, let's say you live in the US and you have a job and you're earning in US dollars, but you want to go and buy British pound bonds or a British pound ETF in stocks or something. You have currency risk, right? You're exposed to the pound sterling, or you're exposed to euro or yen or Australian dollar or Canadian dollar. If you're investing outside of your home currency, you're taking on currency risk. That's the point. Business and economic risk. Yes, so as we're seeing now in the stock market, stocks are crashing because the expectation is of a recession. Well, that's driving inflation and that's driving interest rates. And when interest rates go up, we know bond prices go down. So business and economic risk is part of investing in bonds, real estate, equities, and so on. Liquidity risk is an interesting one. So the liquidity risk is if a bond is not widely traded, which is what happens when you get into the non-investment grade junk, especially the lower level single B, double B, triple C type bonds, these become illiquid. It means there's not very many investors that want to buy them. So if you do, and that company or that government gets worse off, you may not be able to get out of those bonds for a long time, if ever. You may not, and you're at risk of default. So that's what liquidity is. So let's just talk a little bit about default risk. If we look historically here, I spoke earlier about the Fed funds rate. It was up at 20% in 1980 during the OPEC oil crisis. Well, this is global default rates for investment grade and non-investment grade bonds. The orange yellowish line here is non-investment grade junk bonds. And in the 1980s, during that crisis, at any given time, 10 to 12% of junk bonds were in default. Historically, 10 to 12%. And in certain sectors, it would have been much higher. Okay? But 10% is pretty common for non-investment grade during periods of economic stress. During COVID, it popped up around, the non-investment grade risk popped up around 5%, 6%, but I suspect in 2022, it's going to get a lot higher. I think we're going to see another one of these big spikes in the chart ahead in 2022. Down here, this little squiggly black line is investment grade. So AAA, AA, single A, and triple B are investment grade. on average, investment grade, even during these periods of crazy economic stress, they were less than 1% default. So the risk difference is a multiple of 10 or more between non-investment grade and investment grade in terms of overall likelihood of default. So if you go into an investment fund that specializes in bonds, so let's say you go into an exchange traded fund on investment grade and an exchange traded fund on non-investment grade, your likelihood of default in the non-investment grade is significantly higher during periods of economic stress like we're going into in 2023. So if you're going to be investing in bonds and you like the yields, stay in the investment grade space. That's my recommendation. So moving on. Bond risks. So again, what we're showing in this chart here is over a certain period of time, and I've circled 8 years, the CCC, non-investment grade CCC, over an 8-year period, 50% of them go into default. Half of all CCC, single C, double C are in default over an 8-year period. Over a 2-year period, 35 to 40% are in default. So if you're chasing yield and going down into these non-investment grade levels, getting into the CCC space, you're heading into very high likelihood of default. That's what this percentage on the left is. And so look down here at BBB over a 15-year period, maybe 5% of BBBs over 15 years go into default. If you're in single A, double A, triple A, I mean, they don't even show up. Over a 30-year period, you're unlikely to have a default if it's triple A or double A. Very high risk, but they pay you a lot less. They pay you much closer to what the base rate is that we talked about, right? The base rate. Okay, so that's what this chart is all about. Over a certain period of time, you can see how the risk rises in these different categories, particularly the non-investment grade space. So how can we make money from bonds? Well, you can lock in the yield and hold to maturity. If you lock in the yield and hold to maturity, you will get that yield. So if the yield on the bond for 3 years is 5%, well, you're going to lock in 5% for 3 years. Just don't sell the bond, and you'll get your money back at the end of 3 years, and you'll get your interest payments over the course of that time, and you'll make your money. Or what you can do is if you buy into something that's more distressed. So let's say there's a bond that you like in a company, or a company you like, and they have a bond that's outstanding at 80 cents on the dollar, and let's say it's yielding 6.5%, maybe it's a double B, triple B, yielding 6.5%, you go, I like that. But at 80 cents on the dollar, you go, you know what, I've done my research on this company and I think it's gonna boom. I think this company is gonna do really well over the next year, and I don't need to wait 5 years for that 80 cents to get back up towards par. I think that's gonna happen over the next 6 to 12 months, and I'm gonna make a good capital gain out of that. Well, that's another way to do it. That's what I was doing after the Asian financial crisis in the late 90s, early 2000s. I was buying bonds at 20 cents on the dollar, 30 cents on the dollar, and boom, within a year or two, they were back up at 60, 70, 80 cents on the dollar, and we made a killing in our fund. We made a killing. And so this is what investment managers are paid to do. They're paid to go out there and find value in the market to make the investors, yourself when you're investing in the fund, to make you money. Okay? So, but if you're buying single bonds and you want that capital gain strategy, then you're going to be looking for bonds that you expect are going to rise sooner than later, and they're going to do well going forward. Or you buy a bond fund. So let's talk about income overall. So a US Treasury bond, a US 10-year Treasury bond, during the height of the 1980s, remember I told you the Fed funds rate got to 20%? Well, it was an inverted yield curve because they were going into deep recession during the OPEC energy crisis. And the 10-year got as high as 15.82. So that's more than 4% less than the actual base rate, the Fed funds rate, right? But they peaked at 15.82% in September 1981. And then, as I mentioned before, there was this bull market in bonds all the way down to post GFC and just over the last few years. It was a major rally in bonds. Well, what's happening in this chart is you can look at this purple line and see that the 10-year Treasury bond for much of the last 60 years was above 5%. This represents the 5% line, and we're approaching that now. The 10-year Treasury just a couple days ago was at 4%, and it's bouncing around 4%. And if interest rates go up again in November, 75 basis points or 50 basis points, 75 is expected because of where inflation just went higher in October, you're going to see a spike. This thing's 10 years probably going to head towards 5% or more. Over the course of the next 6 months or 9 months, you're probably going to see the 10-year Treasury above 5%, especially if US and the globe the world goes into a recession. Okay, you're going to see higher bond yields across the board, across the globe. Yeah. So this shows you kind of where the Treasury is at and where we're headed now, and why I think it's becoming an interesting time to be looking at bonds again. We're getting paid 4% on 10-year US government debt on an inverted yield curve. As soon as that recession, we start getting out of recession in the next 2-3 years or so, could be longer, could be shorter, but we'll start seeing, we're going to probably see bond yields, 10-year treasuries and corporate bonds up at the 6% handle or higher. It's going to be a very attractive time to get into bonds. So buying bonds, buying individual bonds, corporate bonds, is very difficult, because they have a minimum entry of 100,000, 250,000, 500,000. They're really geared, many of them are geared for institutions. So if you want to buy individual bonds, unless you have that kind of money, you're going to be buying government bonds. So the US 10-year Treasury, I just said, is at 4%. So if you want to buy treasuries, you can buy them. $100 is the minimum entry amount for US Treasuries, okay? You can go on to the government website, but if you're at a big full service online brokerage like Schwab or Fidelity, some of these other ones, you probably can buy the bonds through your online account. If not, you can buy them, I believe, directly from the US government, but I need to double check that. I haven't looked that up for a while. Apologies, I will look that up. Corporate bonds, tough. They have these minimums. So if you don't have $100,000 to invest, and many are more 250,000, this is for institutional investors. It's for the bond funds. Okay, it's for the funds, it's for pension funds, investment managers like Schroders, where I used to work, and so on, and income partners and these other companies, Fidelity, they all invest in these bonds, and so that's where I'm taking you, is into the bond. The bond market in funds. Okay, so it's either unit trusts or mutual funds or exchange traded funds, ETFs. So the safest way to invest in bonds is to invest in indexes. And I say this also in the equity market. And why do we say this? Why do we tell you to go into funds? Most guys like me that have, I have 25, nearly 30 years experience in the investment markets. We say to go into funds because if you aren't analyzing the companies, if you're not spending hours researching what Apple's doing, researching what Adidas is doing, or Nike, or other, companies that you're interested in, if you're not doing the research, you're speculating. Yes, you can say, okay, I believe in Apple, I love their product, fine, put some money into it. But it's pure speculation if you're not doing the equity market research, if you're not doing the credit research on the company, if you're buying their bonds. So that's why so many of us recommend going into funds, because they're diversified, they're safe, and if you're going into ETFs, they're low cost, they're easy to buy and sell out of if you need liquidity in your own life. But this is the way to get diversification. This is the way to get exposure to lots of different markets. So in the slide here, you can go into global bond indices, world bond indices. You can go into government investment grade bonds, like you can get into a treasury bond fund, you can get into a sterling bond fund or a Canadian dollar bond fund, and so on. The US government issues something called US Treasury Inflation Protected Securities. They're called TIPS, TIPS, Treasury Inflation Protected Securities, and they are linked to rising inflation. So TIPS typically perform well when inflation is rising, But because interest rates have been moving so fast to match inflation, TIPS haven't done so well because they're still bonds. So the price of them are falling, even though part of the price is rising because inflation's rising. A big chunk of it's rising because interest rates are rising so fast. So TIPS haven't been great over the last year, but they may do well, and you can get into a TIPS ETF. Then you could get into short-dated government or corporate or government bonds. You can get a fund that is non-investment grade. You can get into different categories. You could get into an ETF that is just single B risk or double B risk, or if you really wanted to, triple C, which is super high risk. But because it's diversified risk, maybe it's an interesting place for you to seek yield. It's like going into a dividend fund on the equity side. You're going into a yield, wanting to get the returns on from the bonds. You can go into these bond funds and get these yields back, which we talked about. Then you have emerging market. So you could buy Asian bond funds. You could buy South American bond funds, or you could talk sector. You could go into a banking bond fund. You could go into a utility company bond fund. Okay, there's lots, and so you can get, holistic. You can diversify amongst the funds. Say if you want to have 30% of your portfolio in bonds, then get into different kinds of funds. Get into some that are a bit more risk, some that are a bit less risk. So more risk would be everything towards the bottom here, be non-investment grade, emerging market, and sector. The more you get into something like a sector, but you could have banking sector bond fund that is all double A or single A, and it's low risk. So now that you've learned the basics, this is how you decide how you want to invest in bonds and what's interesting and attractive to you and what your personal risk tolerance is. Can you stomach being in non-investment grade? Can you stomach going out into emerging markets, into countries that you just don't know that much about? Maybe you haven't traveled that far and wide and you're not sure. But emerging markets, equity funds and debt funds have been beaten up for over 10 years. It is a very, very interesting time to be looking at emerging market debt and emerging market equities. And I think once we get out of this global recession, the emerging market funds are going to boom. So that's something to keep on your radar and keep an eye out for. So look, that's it for me. That's my kind of basic introduction to what are bonds. I hope it was helpful. I hope it was informative. And I know it wasn't that entertaining because it's not the most fun of topics, but I wanted to make it practical, understandable, so you could use this and apply it in your own portfolio, because we're starting to get into a very interesting period where interest rates are getting high enough now where we want to start looking at bond funds to layer in that yield return into our portfolio. Especially if you're looking at dividends, you now have an offset in bonds to diversify your portfolio. I'm Lachlan Campbell. This is Mad Success. Thank you for being here. Cheers.